take the little steps, and they got to be taken every day. Tony Robbins is one of my mentors from several years ago. I was in his mastermind at the highest level, and I'll never forget. It's the way how he says it. He says, execution is everything, which means that at some point you have a plan, you've lined up the people, and then really it's just a matter of doing the do. No pun intended. It's just sticking with it. It's doing it, over and over and over again.
You know, Kris, when I looked at our docket today on who we were going to have on the podcast today, I was really surprised because you've spent the last, 10 years spitting in the eye of financial planners left and right?
Bro, I do not play very well in the sandbox with people that have, let's just say, financial opinions that are just too far different than my own, because I think most people, they just have really crazy, stupid notions about money that they clearly haven't thought well enough through, because they got this one life to live and their choices are not going to lead them across the finish line. So you're right. I mean,
yes, I've heard this line of logic so many times. It's, what are you going to do? You're going to take your 401k and you're going to roll it over and give it to a financial planner, and they're going to annuitize it, and you're going to make $500 a month. Is that what you want? You've done this so many times. So why on earth would you bring a financial planner onto the podcast today?
Either Jim Dew and I are going to exchange blows, or we're going to become better friends. And frankly, I don't know exactly which. But I got to say, though, I almost wonder if you would find it insulting to be considered a financial planner.
I do not like to hang out with financial planners.
What is your title, other than obviously owning a really cool financial planning company? What is it that, what do you do, and what do you consider yourself?
I consider myself an advisor to the entrepreneur. Really, an advisor more of a financial planner, because financial planners, in my experience, have that title, and often they're just very expensive investment managers who are using kind of investment strategies that you could get on your own for much, much less.
Yeah, but my biggest problem, Jim, that I have with financial advisor, anyone's in the first place, is the fact that they're always pushing an agenda. They want something. They're going to push this product because the reality is they're getting paid off of it. They're pushing this product because they're getting paid off of it. What's different here?
Well, what's different is that we don't sell products. We don't make commissions. We don't get paid on any way except directly from the entrepreneur. And the difference is when you have incentives, those incentives are going to drive the advice. And even if it's the model of assets under management, so there are a lot of financial advisors, financial planners, they really make their money by gathering assets. But if you are a business owner and you say, should I pay off my building or should I give you the money? Their incentive is, give me the money. And what we wanted to do is set up a system that was different, where we're just getting paid directly by the entrepreneur, and we're not trying to gather assets. We're not trying to make money in these other ways, because those are ways that create conflicts of interest and then bad advice.
So let me tell you a little bit how I found Jim, because what's interesting for me about who you are, Jim, is when you say that you're working with the entrepreneur and you're helping them succeed, we all got to understand that there's basically entrepreneurs and non-entrepreneurs, right? The majority of people are not entrepreneurs, which means they have a job, they 401k, the IRA, they do the best they can. In their 60s, they have a few $100,000. They have hopefully a paid off house, and that's it. So a financial planner to them is going to take their Social Security and augment it with maybe an extra $1,000 or $2,000 a month. And then they're going to try to guess when you're going to die and try to spend it down so that you have more than $4,000 or $5,000 a month. Basically, people financially are screwed. If you're not an entrepreneur, your options in life become extraordinarily limited, but no one has the courtesy to actually tell you. But on the other hand, working with entrepreneurs doesn't mean they're going to be successful, but they have a shot, right? I mean, that's where the Zuckerbergs and the Musks and the people come from. And frankly, Warren Buffett's, who's one of my heroes because of his whole concept of how he diversifies inside the business asset classes. So you are a funky, weird, strange breed of financial planner, my friend. Because
I'll take that as a compliment.
It is a super compliment. Well, guys, just, I have to disclose, Jim and I don't, I endorse him as a friend. I endorse what he does, but we don't have a business partnership or anything. Jim's just a guy who came into my world that says, wow, you're paying a lot in taxes and you don't have a really solid efficiency plan. And he came in and saved me millions of dollars. And I'm like, oh, this is amazing. I thought I had to have an actual family process, a family practice where I was worth hundreds of millions of dollars before I could actually gain access like that. You're basically taking advice from billionaires that they get out of a family office and bringing it to the masses and to entrepreneurs, and frankly, those that have probably financially figured a few things out. They've probably stepped into the category of no longer they're not breaking 6 figures. They're not breaking 7 figures in income where taxes hurt enough that they need advice greater than what a CPA can offer them.
Well, and Kris, this is almost like a continuation of what we talked about last week, which was, Gen Z is coming up, and even the tail end of millennials, and their interest in entrepreneurship is huge because they see what you talked about. People graduate from college and get a $50,000 a year job, and it's just not enough to live the dreams that they want to live, and so they're turning to entrepreneurship. But most of them don't really know what that means, and so this is like part 2 of what entrepreneurs really need to know about setting up their business, right? I mean, on a call a bit ago, Jim, you were talking to us about, help me out, the ostrich,
juggler, air traffic controller.
Right, and it's like these levels of entrepreneurship. Can you speak to that a little bit?
Yeah, and entrepreneurs, and just to be fair with financial planners, most financial planners, wealth managers are generalists. And really what we do is a specialty, only working with entrepreneurs. And every entrepreneur I've ever met is one or more of these characters. So often the entrepreneur is the ostrich, and that is, hey, I'm going to worry about all this stuff later. I'm going to ignore and avoid the tax, the legal. All this stuff seems so complicated. I'm going to worry about it and just worry about focusing my business and my family.
Which is a really fantastic way to lose a lot of money. It's an irresponsible approach. You're going to give all this money to the government, and by the time you have to write the check, you can be like, wait a second.
Kris,
wait, was this really smart? And guess what? It's too late. Like, you've lost all your choices. You forfeited them because you freaking buried your head in the sand.
Were you ever an ostrich entrepreneur?
Oh, totally was. But in different ways, right? Like, worst way that I was an ostrich is that I owned a business and I didn't understand and respect the language of business, which is accounting. I hated accounting. It made me nervous. It intimidated me, so I ignored it. And until I stopped and took a financial course from an entrepreneur that said, dude, here's how you read financials. Here's what a P&L really is. Here's the things that you look at. Here's what it tells you. Here's what you correct. Until I had that moment, like I was about as inept as it could have come. I didn't understand how to turn accounting into words that could have led to fruitful management of my actual business.
Well, and Kris, recently there's absolute proof that accounting is the language of business, because I watched someone hand you a P&L to a business they were interested in investing in, and they didn't say what it was. All it was numbers. You looked at it for 30 seconds and then said, this is a laundromat, isn't it?
Yeah, it was pretty predictable.
And my jaw dropped. Our guest, Richard, his jaw dropped. They were like, how did you do that? And you're like, I now speak the language of business. This is real.
Yep. And you need to have, by the way, you have to surround yourself with really good people. But I've done the ostrich syndrome thing. So you either find the entrepreneurs that are ostriches.
Yep. Or jugglers.
What's a juggler?
A juggler is the entrepreneur that's trying to manage all these things himself or herself. It's hard because you're trying to keep all those balls in the air. You're dropping balls.
Which things particular are we talking about? Because, I mean, every entrepreneur is going to juggle a lot. But when you say family office, you're talking about some core areas.
Core areas. Tax planning.
Okay.
Legal planning, which could be things like entity structure. This could be operating agreements. This could be, what is your plan for your exit in the future? That would all be under the legal.
So jugglers would be like legal zooming it all day long.
No, it's even worse than that. They hear advice and then they act on it as if that advice is good because they're trying to be everything. This is the lone wolf syndrome. This is the person that says, I have to get, I heard this, so I'm going to cater to that advice. And I also learned that you should get a financial controller versus a CFO. So I'm going to do that. And that's them trying to, I think, juggle everything.
Yeah, I call it random acts of wealth planning. They hear an idea, they try it, they put this into place, and then they have this almost like a Frankenstein financial situation put together from all these odds and ends. It's never good when you're the juggler.
That I relate to so much because in the beginning, so much didn't make sense. It's like my portfolio wasn't balanced. I was the real estate guy. I had all this depreciation over here. I wasn't paying any taxes, but my business wasn't producing the active income that it should have. I was all over the place. Harry.
Yeah.
So after juggler.
The first real progress you make is moving from ostrich or juggler to air traffic controller. And the air traffic controller is the entrepreneur who has really excellent professionals in the areas of tax, legal, insurance, and investment. But the entrepreneur has to manage the team.
Well, this was me before I met you. I had Rob Gill, who was doing my life insurance stuff. I had Tim Weeks, who was my CFO for my company. I had Matt McCleary, that was my CPA. I had Nathan, who ran my entire legal team. And I basically had to assemble all these people, but the amount of time I was putting into like just getting like, they wouldn't talk to each other.
Right, they wouldn't talk
And so
to
it was
each
just always me like, I'm going to get this information, I'm going to bring to this person. Oh, it contradicts it. They want me to go back, and I was like, how come I feel like I'm the guy in the middle,
The air
like
traffic
trying to
controller.
broker information? And it was like a freaking full-time job. I hated it.
Yeah. And often entrepreneurs who are good air traffic controllers, they hold on to it too long. And they don't realize it's just like an entrepreneur that builds the business, himself or herself, and then they become the bottleneck to the growth.
Yeah.
And they don't hire the right people, whether it's
they
a
can't
director
let
of
go of it.
operations. They can't let go of it. And the good air traffic controllers, they think they don't need any more help.
Yes.
And then that limits their growth and what they can really do, not only in their wealth building, but with their time. Because then freeing up their time is so incredible as far as what they can actually do with their life.
So let me kind of frame it up for you a little bit this way on what Jim does, because he's created a niche that doesn't really exist, right? You have to be worth hundreds of millions or billions to be able to have a multi-million-dollar payroll that goes to all the different tax efficiency experts that also includes the people that are managing your entire wealth building world. But how do you get access to that when you're maybe worth $1 million or $2 or $5 million, or when you start having like, oh, I make $500,000 a year or $2 million a year, I now owe hundreds of thousands or millions in taxes. I'm not like rich, but I've got enough money where like life is more complicated now. And that's where you've done something very different and very unique. You basically said, well, why don't we take the billionaire knowledge that I have and break it down and fractionalize it? And the moment I sat down with you at that mastermind and heard that from you, I was like, I get exactly what you're doing. It's so smart. Because Tim Weeks is my fractional CFO for like 30 of my different companies. The difference between, by the way, an accountant and a CFO, like one logs the books and like records transactions and tries to organize your accounting world. A CFO reflects on it and then helps you like make managerial decisions, like do less of this and do more of that. This is bad and here's why. You need to lower your accounts receivable, et cetera. And it was a night and day difference, because now I was like, ooh, I feel like I'm cheating. Like he's only charging me the fraction of a cost of a CFO that might charge $300,000, $400,000, $500,000 a year. He's charging me a tiny fraction because he's doing this for 100 companies with a dozen smart people. But all of a sudden, I get access to brilliant intelligence as if I could afford a full-time one of those. That's what you did for me, because that year I was paying millions in taxes. And before I met you, I actually interviewed a bunch of other groups and two that I went really deep with. And dude, it was going to be like, I was going to have to pay like $250,000 to $750,000 a year to get their intelligence. You brought something up that was way less expensive. It was actually simpler. Your team then understood all the other people I work with. You quarterbacked it. It was not, I mean, it saved me the millions, but it was also a huge time saving. So you really have done something different and bizarre, also really, truly noteworthy.
Yeah, I think one thing I just realized is I need to raise my prices based on what you just said.
100% you should. I'd pay it.
Okay, note to self. One of the things that I think you just brought up is the proactivity of having the right team together and having that team run without you, because too often wealth planning is reactionary. And I tell you, I go to these events and I speak and people say, yeah, I just found out I'm going to owe this much on taxes from last year. And they're really worked up. Well, guess what? You should have known that.
You should have known that
during the year, right?
Right? The month you were earning the money.
Yeah.
So I'm going to bring up
Definitely.
some of my favorite financial planner statements that people put out in the
Let's
world.
do it.
And I'm curious whether you agree or disagree.
All right.
Can
I disagree. No.
Okay.
Okay.
Here's the first one.
Okay.
You should only invest in what you know.
I would take issue with that. And what I would say is it depends on what you're trying to achieve. If you're trying to get rich, then you need to be concentrated. You get rich by being concentrated, whether that's in a business or in certain types of real estate. And when you're concentrated, you better know what you're doing. So some people thought they'd get rich through crypto, being concentrated in crypto, but turns out a lot of those people didn't really know that much about crypto, or maybe no one knows that much about crypto. It's tough subject. But anyway, if you want to get rich, you need to be concentrated. But if you want to stay rich, you need to be diversified. You need to have the money spread around. And there's no way to spread the money around and know everything you're investing in. But you still want to have smart people helping you in those areas.
So building wealth is a matter of concentration. Once you have it, keeping it is a matter of diversifying.
Yeah.
Because if you put all your eggs in one basket, and then if something happens or you can't work anymore, or the economy shifts or changes, or the trends shift, then that one thing that you created all that concentration wealth with now puts your entire legacy at risk.
Right. And I don't have to be that smart. Think of the average billionaire. So UBS does a study of family offices, comes out every couple years. Just a few weeks ago, they came out with a current allocation of the average billionaire. 32% stocks, 15% bonds, 10% cash, 21% private equity, 2% private debt, 12% real estate, 4% hedge funds, 1% commodities, 1% precious metals, 1% art and collectibles, 1% infrastructure.
Okay, so this is really interesting what you just said there, because how you get rich, you can't get rich doing those things.
No.
And what happens is we reverse the process in traditional financial plannership for human beings that have jobs. We're like, oh, I make $150,000 a year. I max out my 401k. My CPA says put in my IRA so I can reduce my taxable income. And then you fast forward 40 years and it's like, cool, you got $300,000 in a 401k, you got $150,000 in your IRA. By the way, the real truth is that in your 60s, the average account is $200,000. But let's just even take someone that has $500,000-$600,000 and a paid off house. They did extraordinarily well. But then you try to annuitize that amount of money at 3%, and you're trying to live off of like $3,000-$4,000 a month. And so what we do is everyone's trained to be risk averse and like, well, out the gate, then you should do what billionaires do. Put some in bonds, put some in these really smart, safe places. But a billionaire doesn't need to grow their wealth. They need to protect their wealth.
That's right.
And everyone else, when they're trying to grow wealth, starts with the protection zone where the ROIs are so low. I'm like, I can see why you work with entrepreneurs, because working with the others, like until they convert over to the light of path from the dark side, dude, their life's gonna be messed up. They just don't know it yet.
Yeah, I agree with you. You have to decide what you want out of life. If you are scared to go for it and be concentrated, then you'll never be extremely wealthy. You can be comfortable. You have to decide what you want. And the people that I work with and the people I hang out with, they want to be seriously wealthy. And I would say at least $20 million of liquid net worth. And to do that, you have to be concentrated. But then as you start to get concentrated, the mistake sometimes these entrepreneurs have, they have a big exit, they get a bunch of money, and then they think, I'm so smart, I'm going to continue to be concentrated in areas that I don't know that well, and that's where they can lose everything.
Got it. So here's another popular notion.
Okay.
Don't ever defer tax anything, because taxes are only going up.
I have heard that. And I'll tell you what the truth is about taxes, because I've heard that. The deficit, taxes have to go up and those kinds of things. But all you have to do is go back and measure the last 20 years, because taxes, by the way, the deficit has done what for the last 30, 40, 50 years? It just keeps going up and up. In fact, as a side note, my wife and I found our wedding video. We've been married for 30 years. And in there, they interviewed like the parents and the different people. And my dad, who's since passed away a year ago. My dad in that video, this is 30 years ago, he said, this is great seeing these young, vibrant young people like you. I hope you can fix the deficit. That was 30 years ago.
Wow.
So the deficit keeps going up. So the government does need more money. But here's what really happens, because we're a political situation. It's not just, oh, financially, we need more money, let's raise taxes. So if you go back and look, Bill Clinton raised taxes. George W. Bush lowered taxes. Obama raised taxes. Trump lowered taxes. And now we're seeing that Biden is trying to raise taxes. So what I know is going to happen is taxes are going to go up, taxes are going to go down, taxes are going to go up, taxes are going to go down, and your situation will change. Maybe you sell your company and you have very little income for a few years. Your income's going to change, the tax code's going to change. So I like you to have a diversified tax basis as well, so that you could have money that's deferred that you can use in a low tax year or when the government lowers taxes, and then money that's not deferred that you can take advantage of tax rates in case they go up. So diversifying your different taxable vehicles so you have control over your marginal bracket year to year.
So I just have to bring this up for fun, because the Biden administration, Biden is trying to pass $1 trillion bill right now because we haven't spent enough trillions of dollars on all sorts of things that have created inflation. So right now, the number one concern and threat to this country is inflation. So what he has is he has an Inflation Reduction Act, and it consists of three things in this 800-page bill. The first one is we're going to put money towards climate change. Then we're going to actually raise taxes. And number three, we're going to throw money at healthcare. And I'm like, none of those things reduce inflation. You're printing $1 trillion. Inflation's going to go up. Anyway, so we live in a world where, yes.
Politicians love to put the words in there that people want to hear, because everyone wants inflation reduction. Yeah, I'm all for that.
Yeah,
But then,
except
like
the
you
bill
said,
has nothing to do
you
with
read
that.
the act, it's really not about inflation. Yeah.
It's funny stuff.
In fact,
Here's another
it will
one.
negatively impact inflation if they're printing
Yeah,
800
by the way,
billion.
it's ironic. It's the Inflation Reduction Act that is going to fuel inflation.
But you
Yeah.
guys know that this idea that printing money increases inflation, it's just a theory, right?
Oh, I know. He's basically said that's a bizarre. Who put that thought in your
who put
head?
that thought in your
You
head?
can you can print as much of this.
And by
this
the way,
money
we're
as you
not in a
possibly can.
recession because we just changed the definition of a recession.
Yeah.
So check on the White
Yeah,
House
and by the way, I will
website.
say one thing about printing money. I'm going to disagree with you a little bit because printing money, yes, is a problem, but more important is velocity of money. So there was a lot of money printed in 2008. We didn't have inflation because there was no velocity of money. If money is sitting in bank accounts or in corporate balance sheets, it doesn't create inflation. It's when inflation moves in the economy, and that's what we've seen. The government put money in the hands of consumers who are going to spend it. It didn't go to wealthy people or a bank. Everyone in America was getting checks. And
Yep.
guess what they did with those checks? They spent it. So now you have a velocity of money, and guess what? A spike of inflation. Of course, you're going to have that.
Yeah. Here's the third one that people say: only invest in things that produce cash flow.
I've heard that a lot. And I like cash flow investments, but I think it's a mistake to limit your options to just that for a couple of reasons. One, if you already have high income, do you really need more income to pay more taxes? Now, if you're really smart and you're a real estate investor and you're using certain types of depreciation, and if you're a qualified real estate professional and you can offset active income with passive gains, then maybe cash flow doesn't create more taxes. But if your cash flow investment creates taxes that you're paying that you don't need to pay, maybe that's not the smartest thing to look at all the time. That should be part of it. Plus, if you're only looking at cash flow investments, you might be missing other investment opportunities. I've had clients made a lot of money in buying land at the right time. Well, land's never going to pay you cash flow. But if you say, I'm only buying cash flow investments, then you never would buy land. So I just think it's limiting to think that way.
Got it. Well, I got to tell you guys, I've had a really great experience with Jim being a part of my financial team. You are really crucial to what we're doing. You know, last year between buying the jet, between buying that large commercial building and a few other moves, we're able to literally shift millions of dollars from what should have gone to the IRS. And we stimulated the economy in ways that the government wanted me to, which meant that I didn't actually have to pay that tax bill. And you helped me navigate something really complex. Also, just the organization of my companies, also my family trusts. It's very, very, very complex, but you've got an amazing team that does that. If people want to learn more about Do Wealth, where do they go?
I'd probably go to our website, dowealth.com.
DEW, Do Wealth.
DEWWEALTH.com. There's two W's in the middle. You can try to connect with me on LinkedIn or Instagram, stuff like that. But I'd say our website's probably a good place. And then also my book, if anyone's interested in buying my book.
Where's it available?
Amazon.
What's it called?
Beyond a Million, the entrepreneur's playbook for expanding wealth, freedom, and time. Can I tell you a quick story about my book? So when my mom was in the hospital, she passed away 3 years ago. She was in the hospital, my book had just come out, and my mom calls me from the hospital and she says, "Did you know your book's on Amazon?" I said, "Mom, everyone's book is on Amazon." She was so proud that she told the nurse I had written a book. The nurse said, what's the name of the book? She said, Beyond a Million. The nurse pulled it up on her cell phone and said, "Your son's on Amazon." And it was like this big achievement for my mom that she was so proud of her son. I wrote a book and I was on Amazon. But anyway, yeah, it's on Amazon.
Well, I appreciate that. One last question for today.
Yeah.
A lot of my basic financial philosophy at its most rudimentary level, right? We're gonna eliminate so many nuances. Is that number one? You have to be a great saver, so that you can become a great investor, so that someday you can be a grand spender. Like the idea is, I think a lot of people today live paycheck to paycheck because they're spending money they don't have and they're spending their seed. Like if I'm a farmer and I've got seed, I got to plant it, I got to harvest, I got to get food to live off of, I need some food to barter so I can get some other stuff besides food, but I need some seed to plant next year again. Most people, because they don't know how to save, they don't have anything to invest, which means they can't get to the real spending that's available out there. That's an oversimplification. But when it comes to investing your money in assets that make you money, like what's your definition there? Because a lot of times I think financial planners, they have a concept of what investing means to them. What does investing mean to you? And what are all the different areas and places people should be investing their money in?
Yeah. I think investing means to me putting money somewhere that's going to grow much faster than places like cash. And one of the worst things, and to your
Do you
point,
by that, do you mean by negative 9.1%?
exactly. I love that people are like, well, I've been in cash. I haven't lost anything this year. It's like, really? Okay. I don't know how that math works.
Well,
but,
in 5 years, let's check back and see how you've lost
yeah.
half.
To me, investing is putting money in things that appreciate much faster than either saving them in a cash account or something that's conservative like that, or putting them or buying stuff with them. Often people are buying things that with their money, to your point about spending, that is really marginalizing their future. And one thing people should think about is if they want to buy something, they should compound that by what they think they can get in an investment return, whether it's in real estate or private equity or stocks and bonds or venture capital or any of the things that grow. Figure out what you think you can get in an investment return, take that purchase price and compound that out over 20 years, 30 years, and find out how much that really costs you to enjoy that thing that you think that you have to have. That's where the numbers get huge, because people are like, oh, it's only $1,000, it's only $10,000. Run that forward 20 years and you might be giving up
Millions. Well, I remember one of my very first mentors in the game of real estate. I pulled up to his house. He had this beautiful multi-million-dollar house. He had this brand new boat being pulled by this brand new truck. And I was asking about his boat. And he said, oh, this house I bought over in Lehigh pays for it. I'm like, that makes no sense. And he said, no. The money I could have used for the boat, I bought an investment property and it has a positive cash flow, it pays for the boat. And so John was already attempting to teach me different principles of building wealth. But at some point, if you become successful at building wealth, which is what everyone would hope for themselves, you're going to owe a lot in taxes. And at that point, you either bury your head in the sand and be that ostrich, you try to manage and juggle it, or at some point you got to graduate and do what I love the most, which is I think one of the greatest privileges for me in making money is I love spending it on experts that can show me how to make or save more money, or will help me reclaim my time and save my time. You've definitely done that for me in a major way. Anyone who's enjoying today's podcast and just wants kind of a final nugget from you on your space, your industry, the last 20 years. I mean, last year you had one of your wealthy clients that started 20 years earlier have a $1.6 billion exit. You've seen the full gamut of what wealth over time can be for people. So what's your final impression that you want to leave for everyone listening today?
Yeah, I think you want to be clear on what you want out of life. I think too often people let life kind of run them around and direct where they end up, instead of thinking about what do you really want out of your life. And dreaming big, like when you were a kid, I don't know if you ever thought you'd have this life, but I think if you can create this image, this compelling focus to pull you forward, that's part of it. But then you have to do the day-to-day things that get you there. And too often, I think either we have the dreamers that create these ideas of what they want in the future, or we have people that never dream. You want to dream and create your vision, but then you have to do the things day-to-day, month-to-month, year-to-year that will get you there. And often we think if you're not at a level of wealth, you probably see people who are wealthy and you just think, oh, that person got lucky, or I don't know how they got there. But it is an actual process. And like Jim Rohn said, success leaves clues. And you can look at a Kris Krohn, you can look at people who've created amazing wealth, and all you have to do is follow the steps that they took. And they're not these huge leaps, they're all these little steps to get there. And I think that's what's most important. I have a friend who is a mountain climber, and he said that on the steepest parts of the mountain, and these are people that summit the Matterhorn and stuff like that, he said on the steepest parts of the mountain, as they're getting toward where you're on a rope, he said that the best mountain climbers, they take small steps. And I thought about that. I thought, that's interesting. Why do they do that? And he said, because when you're taking these big steps, you're burning too much energy. You're using too many of the big muscles of your body. So he said they take little steps. And I thought, I think that's a life lesson right there, is that you really, when you have something hard like getting seriously wealthy, because unfortunately, most Americans don't become seriously wealthy, even though they could. And I think part of the reason why is they either don't try, or they try to take these huge leaps. Instead of taking those little steps over and over and over, that's what is going to get you to the dream or to the vision that you have that others are never going to achieve. Take the little steps.
Take the little steps, and they got to be taken every day. Tony Robbins is one of my mentors from several years ago. I was in his mastermind at the highest level, and I'll never forget, it's the way how he says it. He says, execution is everything, which means that at some point, you have a plan, you've lined up the people, and then really it's just a matter of doing the do. No pun intended. It's just sticking with it. It's doing it, over and over and over again. Well, that's what fractional family office looks like. The last thing that you said that I really appreciate is that at the end of the day, success is more about modeling the heck out of people that are successful. Everyone looks to the innovation of today and they're like, wow, they got lucky. And that's because they don't understand the parallel. No one is getting lucky. Really, for the most part, people are just repeating and modeling successful approaches. And that's what they all share. If you take a look at any of the successful billionaires and multimillionaires and the thought leaders that are out there who financially crushed it, all they're doing is they're modeling what works. Like, I took a real estate model. I certainly didn't invent it. And now I've done it 7,000 times, right? Over $1 billion worth. All I did is I found a model that worked and I did it over and over and over again. Right now, I find other businesses that work and I model them and I do them over and over and over again. I found a way for social media to really help me find my tribe and my people that I want to create value for and connect with. And guess what I'm doing? I'm pouring gas on what's working, and I'm just taking that model and I'm exaggerating it. When I found you, I wanted to know, how are you creating savings for such financially wealthy people? And when can I start having a gym in my life? You came into my life, it made sense. I had a lot of money to save, but frankly, I'm not coming up with ideas. I'm just modeling a better, more intelligent approach. I think the problem where we go wrong as human beings is that we really just think that it's all on our shoulders, and no one is really, for the most part, smart enough to figure everything out. You're going to concentrate in an area 2 or 3. You're not meant to be brilliant on everything, which means there's no real way to the top unless you learn how to acquire a team and step into that team. You've been that team for me, and it's really just modeling what works. And I think there's a life lesson in that for everyone as well, which is, if you don't have what you want, find people that do, and then model the system, because that's how you're going to get there.
Yeah, no doubt. Can I tell a quick story about, you mentioned my clients that sold their company for $1.6 billion to Blackstone. The way a lot of people think, wow, how did they get so wealthy? I know the whole journey. I was with them the whole journey. And the first time they sold their business, they sold to a publicly traded company whose stock went delisted. They lost everything. And you would think that was a complete tragedy in their life. But actually what happened is, when they were rolled up into this public company and they just had the public company stock that became worthless, they got to meet these other business owners in their space. And they learned from one of these other business owners how to manage inventory in their business. Then they were bought, again, in the future, they were bought by a company, all cash deal, and they ended up restarting their business. But in that all cash deal, they got to work for a bigger company that was trying to do a roll-up, but didn't succeed. But they learned how to do a roll-up. Those two things, inventory management and how to do a roll-up, is why they sold their company for $1.6 billion. The first time they lost everything to learn that lesson. The second time they actually had a bunch of cash when they learned that lesson. But it's about the lessons you learn along the way. And often when life hands us things that we don't want, we think about how disappointing that is. I was just remembering a quote from Alexander Graham Bell, one of my favorite quotes. He said, "When one door closes, another one opens, but we often stare so regretfully and so longingly at the door that closed, we don't see the one that's open for us." And I'd say that's the other life lesson, besides the small steps, is look for what you can learn from every situation. And if you've lost money because you did a bad deal, what can you learn from that so the next time you do a good deal? And that's how, what you've done, Kris, is you've built this incredible team and this incredible wealth building machine by learning from mistakes and failures and learning from other people. I mean, it's great to learn from other people because then you don't have to make the mistake first to feel the pain to learn from them. So that's what you should think about.
Lessons beat outcome. And if you can value the lesson, then eventually you're going to learn how to predictably produce the outcome. Jim, thank you so much for being here. Carson, it's another great conversation. I finally got to sit down with someone in some financial planning element and not chop each other's heads off.